Okay, today we are looking at accounting concepts and convention. Now, accounting concepts, these are ideas, assumptions, and principles that guide the preparation of accounting information. You know, when you are preparing account, we said that account is guided by principles, the rules that you must use in preparing account. So if you look at this way, I say accounting principle is divided into concept and convention. Now, in the textbook, they may mix everything up for you, but they are separate. However, you just understand what they have. So accounting concept, of course, are those ideas, assumptions, and principles that guides the preparation of accounting information. That is, when you want to prepare an account, you don't just prepare it anyhow. It follows some steps, some ideas, some assumptions, some principles. There are ways you must do it. That's what accounting concept is talking about. The accounting convention is now saying that these are the guidelines used in resolving conflicts that arises from the application of accounting concept. Because it's possible that two accounting concepts are conflicting when you are trying to prepare an account. So what we use to resolve that issue is accounting convention. And of course, the accounting principles, which is accounting concept and convention. Accounting concepts are these. We have going concern, business entity, periodicity, historical concept, dual concept, matching concept, realization concept, and accrual concept. Those are accounting concepts. Then accounting conventions are prudency or conservatism. That's another name for it. Objectivity is another convention. Materiality is another convention. Consistency is another convention. Substance over form is another convention. So, but if you see it that they mix everything together, never mind, you are still on point. They are all accounting principles. Okay, so having said that, we are now going to take all of these one after the other and try to explain them. What do you mean by going concern? Now, going concern is saying that once a business is formed, are you writing? Okay, so the first concept we are looking at is going concern. What is going concern saying? Going concern is saying that once a business is formed, that business is expected to continue for life. So that is, the life of a business is endless. That's what this concept is saying. That's what that principle is saying. That is, once a business is formed, it is expected to continue till eternity. Eternity means forever, endlessly, continuously, perpetually. The business should just be there. So nobody intends to start a business and then expect the business to close down at any time soon. And so that principle is guiding the business to say that once a business is formed, the business is expected to exist for life. That's what going concern is saying. Business entity, what is that saying? Now, business entity is saying that once a business is formed, the business is different from its owner. Once a business is formed, the business is different from what? From the owner. So you can't start a business and say you are not the same thing with your business. If you take the money of the business and spend it for personal use, you have done what we call drawings in accounting. So drawing means when you use the money of the business for your own personal use and you say, am I not the owner of the business? Am I not the business? No. In accounting, once you form a business, that business is existing on its own. It's a juristic person. juristic, you see that? A legal person, somebody staying on its own, someone that can acquire property in its corporate name, someone that can sue and be sued. So once a company is formed, it becomes an artificial person. It becomes human being, which you also call juristic person. You can now do what? Transact business in its corporate name, can buy property in its corporate name, can sue and be sued in its corporate name, can do many things in its name. And that's why if you go to First Bank, for example, and you see one of the tables there, they will put First Bank. That table does not belong to anybody. It belongs to Mr. First Bank, because Mr. First Bank is now a human being, even though it is a business, an artificial person. Okay, periodicity concept. Now, periodicity concept is saying that accounting information should be prepared in periods. Accounting information should be prepared in periods, usually known as accounting year. Accounting year. So, for better interpretation of account, so preparation of accounting information, in a particular period called accounting year, for better interpretations of account information, for better interpretation of accounting information. You see, businesses used to have what we call accounting year. Some people's accounting year starts from January, ends at December. Some people's accounting period starts June and ends July of the other year. So accounting period, when you are preparing an account, you are expected to have a period. So if you want to be preparing an account that is on monthly basis, or annual basis, or quarterly basis, or half-yearly basis, it's not that you just be preparing an account and they say this account is for what? This is the account of since 10 years ago. No, you are expected to put that account in period, whether it is every month or every week or every year or every day. So when you prepare accounts in periods called accounting year, that is what we call periodicity. So account information are expected to be prepared in periods. That's what periodicity concept is saying. So if you want to be preparing it every 6 months, every 2 years, every year, every 3 weeks, whichever, make sure that you prepare it in periods. That is what periodicity is saying. Now, the next one we want to look at is historical concept. Are you with me? Historical concept. Okay, so the next concept we are looking at is historical concept. Now, historical concept is saying that assets that are acquired should be recorded in actual value, not market value. It's possible that you are representing your company and you want to go and buy a car for your company. And of course, everybody knows that the worth of the car in the market is 2 million. But by the time you go to where they are selling the car, they give you a discount. And then you got the car for 1.9 million. And so, when you want to record in the books of account, you will record the 1.9 million. Don't record the 2 million. That 2 million is the market value. But 1.9 million is the actual value. So, historical cost is saying that values of an asset that are acquired by any organization or business should be recorded in their actual value, not market value. That's what historical cost concept is saying. Dual concept. Now, dual concept is saying that every accounting transactions have two aspects. Every accounting transaction have two aspects. That is the receiving aspect and the giving aspect. And then the dual concept is now saying that you will always debit the receiver and credit the giver. Debit receiver and credit the giver. So for every debit entry, there must be a corresponding credit entry. That's what that concept is saying. For every debit entry, there must be a corresponding credit entry. That is, debit the receiver and credit the what? The giver. So that's what dual aspect is saying. So he's saying that every accounting transaction have two aspects: the receiving aspect and the giving aspect, and that for every debit entry there must be a corresponding credit entry. So you debit the receiver and you credit the who? The giver. Okay, so the next thing we want to be looking at is matching concept. Matching concept, realization concept, and accrual concept. Now, what's matching concept saying? Matching concept is saying that the income of a period, in an organization should be matched with the expenses of that period. The income of a period should be matched with the expenses of that particular accounting period. What that is saying is that if you are doing a business and then you make 200 naira and then you are now owing 300 naira, that means you are owing more than what you are getting. You know, some people will now say, don't worry, by the time we sell next month, we will now remove the balance of 100 naira. No, account is saying don't do that. Don't remove the expenses of this year in another year's income. So some people will say, I've spent the money now, maybe when I make another money, I will now put the money back. You don't do that in accounting. Whatever income you make in a particular period, let it go with the expenses of that period. Not that you will go and be spending money that you don't have. You will now carry over of expenses to another period. No. That's what matching concept is saying. So it means if you make 2 naira this year, let it be that you will spend out of the 2 naira. Let the expenses you will make be out of the income you have made. Don't go and remove expenses of one period from another income. Or don't put the income of one period on another expenses. So if you always prepare your account every 3 months, the first 3 months, if you have any expenses, deduct it from the income of that first 3 months. Don't go to the next 3 months and now deduct the expenses of the first 3 months. No. Or use the income of next 3 months to meet the expenses of the previous 3 months. It's not allowed. That is what matching concept is saying. Let the income of the period go with the expenses of that period. If you enter another period, let the income of that period go with the expenses of that period. And you know what that is doing? That is helping you to be prudent, so that you won't just go and be spending the money you don't have. So some people in their own business, they will spend all the money hoping that, oh, in another accounting year, I will make the money, I will now be paying debt. No. Okay. Realization concept. Now, realization concept is saying that you recognize any transaction once there is an evidence to show that that transaction exists. So realization concept is saying you will recognize an accounting transaction. That is, a business should recognize an accounting transaction once there is an evidence to show that that transaction exists. So what that is saying is that if, for example, somebody buy on credit and then the person gave us some information and then we have given the person goods and then we issue a document to show we are giving him something on credit, then that document alone is enough for us to record that Mr. So bought this thing from us. So when you do any transaction, once there is an evidence to show for it, you can recognize that transaction. And that's what realization concept is saying, whether it is cash or credit. Okay. And the last one is the Akura concept. Akura concept. Okay, so Akura concept is saying that revenue is recognized when they are earned and expenses is also recognized when they are incurred, even though it's not yet paid for. Look at what Akura concept is saying. He said that revenue is recognized when they are earned, even when they are not yet received. And then expenses are recognized when they are incurred, even when they are not yet paid for. That's the way we should put it. Revenue is recognized when they are earned. Are you with me? Even when they are not received. Have you written that? And expenses are recognized when they are incurred, even when it is not yet paid for, or even when they are not yet paid for. So what that is saying is that when you are in business and then somebody buys something from you and be sure that the person will pay, put it in your account that they bought that thing, because they will pay you. So you have earned it even though you have not received that income. Then when you buy something on credit, even though you have not paid, you know you will still pay. Recognize it, even though you have not yet paid for it. That's what Akura concept, because accounting is always either on cash basis or Akura basis. Cash basis means that the business you are doing is cash, but some businesses are done on credit. So it's either it is cash basis or Akura basis. So all this we have explained are the accounting concept. So the next thing we want to explain are the accounting conventions, which include prudency or conservatism, objectivity, materiality, consistency, and substance over form. Okay, quickly we want to look at accounting conventions. Now the first one is prudency or conservatism. What prudency or conservatism is saying is that don't anticipate profits as a business. That is, business are not expected to anticipate profit, but make provision for possible losses that can occur. That is, as a business, you should underestimate your income. If what you are expecting is 100 naira, prepare as if what you will get is 50 naira, so that you won't overestimate. Then if what you are going to spend is 80 naira. Prepare as if you will spend 100 naira because you don't know what will happen. So businesses are expected to underestimate their profit and then prepare for possible loss. That is, underestimate your income, overestimate your expenses. That's, you know, some people, if they want to go out of the house, they will say transport from that place to that place, it will be 500, but let me just hold 800. You may get outside now, they will say it is 800. What you are doing there is that you are preparing for over expenses. It's good like that. So you have to do that in account. Then if you are going to someone to go and collect money, maybe the person promised to give you 10,000. You can say, well, I know if I get with the person, he may not give me 10,000. Let me prepare my mind that he will give me 7,000. You are underestimating your income. So in accounting, that's very important that you should do. Underestimate your profit and then overestimate your expenses. That is, don't anticipate profit, but prepare for what? Possible losses. That is what prudency or conservatism is saying. Now, objectivity. Now, what objectivity is saying is that in preparing the book of account, you have to be objective. You have to prepare accounting information based on facts. Accounting information are expected to be prepared based on facts. That is, don't prepare accounting information based on your personal opinion. Prepare accounting information based on facts, existing facts, facts that can be seen. That's what objectivity is saying. And in preparing accounting information, don't let there be any element of biasness. Don't be biased in preparing accounting information. Don't prepare account information based on your personal opinion. Prepare it based on fact, the way it is expected to be, the way it should be. That's what objectivity is saying. Materiality concept. Now, materiality concept is saying that when you are preparing accounting information that are only relevant are to be recorded. Don't record information that are not relevant when preparing accounting information. So materiality concept is saying that in preparing of accounting information, prepare relevant information. The information that are not relevant to the business, don't prepare them, don't record it. Now, consistency concept. Okay, so the next one we have is consistency. Consistency, of course, is saying that when a business is using a particular concept or method in preparation of its account, it should continue with that method or that concept. So when a business is using a particular concept or method in preparing its accounting information, that account information should continue using that concept when it has to be prepared. That's what you should be consistent. An organization is expected to be consistent with any method he has started with to prepare a particular account. So it's just like saying, if we have been using a method to prepare our account in this company, we should continue with that method. We should not change. We should be consistent, because trying to change may make some issues to come up when we want to interpret the statement of that account. And of course, the last one, which is substance over form. Now, substance over form is saying that in recording accounting information, the financial reality should be considered and not the legal standing. The financial reality of that transaction should be considered and not the legal standing. That is, when you are preparing accounting information, pay attention to the accounting principles and concepts. Don't pay attention to the legal aspect of that account. So you pay attention to the accounting principle in preparing that information, not the legal aspect of the account. So with this, we have come to the end of accounting concept and convention.